get started. I want to welcome everyone that's here. So far, we're having very good attendance tonight. This is going to be the first of 9 webinars that we are putting together this year for anybody that's interested in any type of education or wanting to learn about certain topics. I do want to you to know the original calendar, there has been a date change for December the 18th. So I wanted to make you aware of that. If you do not have a calendar like this, you can always email me at craig@morrisvilletax.com and I will send you a copy of this calendar. The good news is we have a lot of different presenters. We're going to have someone from the IRS speaking. We're going to have professional people, CEOs speaking from different companies, whether it be, I believe Urban Catalyst, their CEO might come on and speak to us. Prudential's doing Social Security. Obviously, I have someone coming from the IRS for the IRS compliance and collections. Allianz, we have US Energy. We have a lot of different companies that are going to come on and I'm going to tell you about certain things that could help with tax mitigation. We also have some national speakers that are going to be joining us. We have Deanna Whitlock and Amy Wall, who typically speak to tax preparers around the country. They're actually going to be speaking to you. Deanna speaking on November the 8th, and Amy Wall is speaking on December the 18th. We also have Judson G of JHG Financial, who will be speaking on the 5th. So that's all the good news. The bad news is I'm speaking at 2 of them, and one of them happens to be tonight. Unfortunately, I am not a professional speaker, so you bear with me. But we are going to go through 3 topics that I think will be beneficial to all of you at some point. Now, we are recording these webinars. I've been asked by several people. We are recording the webinars. They are going to be posted to the website, my website. Now, the problem is this is my first webinar. My IT guy says that they've got it covered, so I don't know exactly when it's going to the website, but it will be going. If you have questions in any of these webinars, you're not able to ask them. It's very important. The topics that we're going to be talking about, it's going to be generic. We cannot, each individual is going to be different. So any questions that you have, I want you to email them to me, and within 24 to 48 hours, I will get answers back to you if you have questions on any of the webinars. So none of the presenters are taking questions. It's just it would be very tough to do, especially with the amount we have on right now. Let's see. That's about all I have on the start of the webinar. So let's get started. And let me pull up what we're going to do from the very beginning. All right. We have 3 topics we're going to deal with tonight. This first topic is a SALT workaround. And before I start, I'm supposed to give this disclaimer to everyone. This presentation is for informational purposes only and is not meant as accounting, legal, or tax advice. Does not take into account your particular situation. So before acting on any information that is presented to you tonight, you need to consider the appropriateness of the information for your situation. In other words, my clients, you need to call me. Clients of other tax professionals, you need to call them. Again, the examples today are very simple, just so we can get it through and get some understanding. First one I want to talk about is it's a new law that came out in 2022. It's called the SALT workaround for pass-through entities. Well, first of all, a pass-through entity is an S corporation or a partnership. The reason it's called pass-through is because most of y'all here have a S corporation or a partnership. Your S corp or partnership does not pay tax. It passes through to the shareholder or shareholders, partner or partners. So what we're trying to do is figure out a way to work around, and we're going to get into what SALT is. So let's talk a little bit about what this SALT workaround is. What is SALT? SALT stands for state and local taxes. That is on your personal returns. That is state and local taxes you pay, whether it's income tax, real estate tax, property tax. It is reported on your Schedule A as on itemized deductions. A lot of y'all might not even itemize. You may use the standard deduction, so you're not even getting any deduction whatsoever as far as it relates to the state taxes. So, however, depending on your situation, you might not get to enjoy the full deduction. I have kind of put together a little tax problem with John and Mary Smith is who we're going to be dealing with today. So what we want to do, bear with me, I'm going to switch over to my software. We are going to be looking at John and Mary Smith. And yes, I know I left the I out. I did that on purpose. These are fictional people, and I've made the numbers pretty simple so we can understand. The first thing I want to go over is SALT and what it is. Again, SALT is found on Schedule A, which is your itemized deductions on your personal return. In this section right here that says taxes paid by you, state and local taxes, if you take the SALT, there's SALT. This is a deduction that you get to take. And in John and Mary's case, they actually paid state and local taxes of $18,208. That's how much they actually paid in this scenario. But the IRS is limiting them to $10,000. That's all they get to take off is the $10,000 off of that deduction. So they've lost out on $82,008 worth of possible deductions. So the IRS says, nope, can't have it. We only get 10 grand. Well, the thing that we have to look at is there is a possibility that they can do a workaround and make part of that tax deductible. So let's take a look at John and Mary as a whole. John here has a W-2. John works for XYZ company. He makes $160,000. Mary, his wife, she has an LLC that she owns, and it's taxed as an S Corp, ABC LLC. And obviously, most of y'all are S Corp owners. She has to take a reasonable salary. Now, I'm not going to get in a debate tonight whether this is reasonable. That's on for a different webinar. But here, Mary's taking $40,000 as a W-2, as you can see. And she's also getting a K-1 from ABC LLC of 100 grand. So all total, you've got wages for John of 160, W-2 for Mary of 40 equals 200, plus you got another $100,000 from Mary's K-1 coming from ABC as a shareholder. So their income for this year is 300 grand. Now we get into their deductions, and this goes back over to the Schedule A. That's where the deductions come from. 10,000, that's all they can get, even though it was over $18,000. Only get 10 grand deduction. They get a 12 grand deduction for their mortgage interest, and they gave 10,000 to the church. So their deductions were 32,000 is what they get to write off. But we've already seen they actually had over 40. They only got 30. So once we get everything down, John and Mary unfortunately owe the federal government $18,997. As far as the state goes, let's see what they owe the state. The state always starts with the 300,000. They start with the adjusted gross income. They stick it right there. They're going to give their deductions, and they owe the state $4,990. So once we look at the total that John and Mary is about to pay, by the way, don't write this bank account number down. It doesn't exist. John and Mary are going to pay $23,987. Now, I proposed to Mary back in July a way to work around this and save some money. So we're going to pretend that Mary took my advice. So what we're going to do is we're going to look at a SALT workaround and see what should have happened for Mary. So first thing we're going to do is we're going to go to the ABC LLC. That is her company. What this workaround is intended to do It is intended for ABC LLC to pay for John and Mary's state taxes. You remember, it was like $4,990. So here's her original K1. There's the $100,000 that you saw went over to her personal return. And on this $100,000, that's what she paid tax on, both fed and state. Now, let's say Mary listened to me back in July, and I said, hey, Mary, what I want you to do is I'm projecting that you're going to do $100,000 this year. Again, you just saw the 100, but we need to pay estimated tax payments. So we go in here and I tell Mary it's July. I want her to pay $2,500. Excuse me, not her. The ABC LLC pay $2,500, and the ABC pay $2,500 for the fourth quarter. So her company is going to pay $5,000 towards their personal tax. So she makes those payments, and we go in here and we elect for the S Corp to be taxed, which normally S Corps are not taxed, but we want it to be taxed. So the S Corp ends up paying $5,000 in tax. The good news is, remember how that money, when it went to Schedule A, you couldn't deduct it. But look what happened when you paid the $5,000. When ABC paid the $5,000, they got to deduct it. Well, this flows through to Mary. Instead of $100,000 flowing through, only $95,000 flows through. And you think about it, that's $5,000, and they're in the 24% bracket. I mean, that's $1,000 worth of savings right there. So the other part is, you'll notice that now, I should have showed you originally she had 0 down here, but now that she's taxed as an S Corp, that number is very important right there. That's going to trigger their personal return not to pay state tax. So what I'm going to do is I'm going to export this new change over. So it's my computer over to Mary's personal return. All right, we're going to go look at her personal return. But I do want to point one other thing out to you. And that is, remember, Mary, the ABC, paid $5,000. There it is. But now, remember, that old tax was $49.90, but that was on $95,000, on $100,000. Now it's just on $95,000. And look at the income tax. It was only $47.41 is all they had to pay. I know she paid ABC paid $5,000, but guess what? ABC's getting a refund of $259. So ABC, in essence, only paid $47.41 in tax. Now let's go back over to, whoops. Let's go back over to their personal return and see what the outcome is. So remember that $95,000 I showed you on the bottom of the North Carolina K1. We actually have to go put that in down here where it says tax pass-through entity income. We're going to put $95,000 there, because they do get a $95,000 deduction off of their income. And let's see, then we'll go take a look. So now what you're going to notice, they still got the $200,000 in W-2. That doesn't change. But now they've only got $95,000 they're going to get taxed on instead of that 100. So they only owe $18,037 when the original amount was $18,997. And of course, on the state, they owe 0 because it's already been paid. So let's run back over to here. And so what was best for John and Mary? It's pretty simple. We did, before the SALT workaround, the tax that they outlaid was $23,987. By doing the exact same thing, they didn't do nothing. They just had ABC pay for the state tax. Now they only paid $22,778. So using this SALT workaround, John and Mary saved $1,209. And again, it's money they were paying anyway, so That is something that, it's going to be good for some people, not good for others. So what is best for you? Okay. Everyone's different. I cannot answer, everyone tonight. That's impossible. This is very time sensitive. If you're interested, we need to get your first payment in by September 15th before the estimated tax deadline. Lots of you, and I have quite a few. We do about 150 to 180 S corps. A lot of you will save money on this. Matter of fact, I was dealing with the client last night, and I think they're even on. And I won't mention names, but I think their savings was in excess of $13,000. So this can be very big for some people. What I plan on doing is I'm going to use Labor Day weekend because I think it's that important. If you're interested, I want you to email. You can call the office, but they're really not going to know my Labor Day schedule. And I want to have a 15-minute phone or Zoom. Phone's fine, doesn't matter. That's going to force me to open up your file. We're going to run some quick numbers, and we're going to see if it's best for you. I will try to make myself available to all that are interested. Once again, it's about a 15-minute phone call. If you're interested, we see it's worthwhile. I'm going to get the estimated tax payment set up for you, and we will start doing this. Maybe some people that it's not worth it. We'll find out. That is about all that I have on the SALT workaround. Now, this was a very simple example. Everyone's going to be different. I just wanted you to understand the premise that the company is going to pay for your state tax. That's what I need you to know, and it's going to work around that SALT workaround that you saw on the individual side. So let us move on. I believe that's all okay. Let's move on to company paid medical and life insurance. Should I consider having my company pay for my medical and life insurance? I'm not going to read this all to you again, but once again, this is not tax advice. Everyone's different. So I just have to throw that in there so I don't get in any trouble. So medical insurance, let's start with that first. If you are not on a group plan, like through your spouse, you may be the S corp owner, your spouse may have a regular W-2 job, you're on their medical, not a big deal. But if you're not on a group plan through your spouse and you're paying medical insurance personally and reporting it on Schedule A on an individual tax return, well, if you are a partner, if you have a partnership or an S corporation, we may want to look at having them pay for the medical insurance. Once again, anytime you put something on Schedule A on the individual tax return, sometimes you just don't get credit for it. Just like in this case. However, that deduction may never get used, but through proper planning, you can get 100%. So let's go back and look at the John and Mary's situation. Okay. John's employer does not offer medical insurance. John and Mary have a policy through Blue Cross Blue Shield and pay $1,000 a month. Should Mary's S corporation pay for the insurance? So currently, let's run back to the software. There's the $12,000 that Mary's been paying. Mary and John have been paying $12,000 out of pocket, and it's right there on their return. Medical and dental expenses, $12,000. However, again, you're on Schedule A, you're subject to 7.5% of your AGI, which means the first $22,000 in medical doesn't count. So they got a big fat zero for that $12,000, a big fat zero. It did them no good. But talk to Mary, say, hey, Mary, why don't we have ABC pay for this? Now, when ABC pays for it, they get the full $12,000 deduction. Well, ABC getting a deduction is the same as Mary getting a deduction. So now instead of that 95, it's down to 83. So once we look at that, their federal tax savings is $2,304, and their North Carolina savings is $599. Well, that $599 will actually be refunded back to ABC because remember, they paid the tax. But the bottom line to John and Mary is they saved $2,903 on an expense they were already doing. So I want to make sure if there's any of y'all out there that are paying for medical individually, this is definitely something that I do want you to consider. Okay. So as we can see, if Mary lets the S Corp pay for the medical insurance, she's skipping Schedule A, thus not having to meet the 7.5 AGI. This allows John and Mary to get the full deduction and get the $2,903. John and Mary now has saved over $4,000 simply by using the S Corporation to pay for the state taxes and the medical insurance with expenses they are paying anyway. So nothing's changed. They're just saving money. Now, there is things that do have to happen. I make it sound easy, but it's not totally easy because unfortunately, Mary does have to include in the shareholders the insurance. Well, medical insurance payments will be included in her W-2, grossed up in box 1. And if it was a partnership, it is grossed up in guaranteed partner payments. However, you don't have to worry about that because we're going to get to deduct that right off your tax return. We're going to put it on and take it off. Your deduction will still come through on the reduced income from the K-1. So if you're not on a group plan or through your spouses and you're paying for medical insurance individually, let me know. Let's see if it works for you. I mean, I'm an S Corp. That's how I run my medical, and it saves quite a bit of money a year. I'm just going to touch real quick on life insurance. Life insurance premiums are not deductible on your personal return. So if you go out and buy yourself a $150,000 policy individually, it's not deductible anywhere on your tax return, on your personal return. However, a company, ABC LLC, can pay life up to $50,000 of life insurance for employees, get the deduction without the employee including in his or her income. So Mary could go get a $50,000 life policy. The company can pay for it, and it would not have to be put on her W-2. Now, if the company decided to get her $100,000, she would have to only include the premium on her W-2 for the additional $50,000 worth of coverage. However, this can work for some people. If the life insurance policy is owned by the business, and typically the business is the beneficiary, then the business then can deduct the premiums. I have several clients that have done this. The business is paying for the life insurance. And in the long run, their beneficiary is still getting the money. It's just that they're deducting this expense, whereas if they just went out and did it on their own, not deductible. This solution will not work for everyone. And again, if you're interested in it and the feasibility of your business, give me a call. And again, like I said, everyone's situation is different. All right, let's move on to the last one. Hopefully I'm not moving too fast for everyone. This last one affects all of you. If you have an LLC, you have a corporation, you file anything with the Secretary of State, you need to listen up. I promise you this affects you. Once again, before I start, I got to throw this disclaimer up here. Same thing you've already heard about. This is not tax advice, legal advice, or accounting advice. Well, we can talk individually if we need to. All right. I want to talk about this new BOI reporting that's coming out of FinCEN. Now, that is the U.S. Treasury Financial Crimes and Enforcement Network. The same people that bring you the FBAR. Some of y'all might not know what the FBAR is, but that is a federal requirement to let them know if you have $10,000 in a bank account or brokerage account overseas. These people have teeth, and they can bite hard, and they don't let up. So this is something that you need to take serious. So let's talk about this BOI reporting and what it is. What is BOI reporting? It is beneficial ownership information reporting, that is giving FinCEN your company and personal information. So you're about to give them information that they didn't have access to. Well, they had access to it, but they're going to put it off on you to give it to them. So why is FinCEN requiring this beneficial ownership information reporting? There are some bad actors out there that are hiding their identity through LLCs and so forth, and they're committing financial crimes. The Corporate Transparency Act that passed in 2021 is what has given them the permission to do this so they can correct the issues. But unfortunately, it's going to hit the innocent people too. So you want to know, do you have to file? Well, let's see who's excluded. If your business has more than 20 employees, you're excluded. I don't have too many clients that have that. If your business revenues exceed 5 million, you don't have to file. I don't have too many businesses that have that problem. Or if you meet one of the following exemptions. So if you're a securities reporting issuer, obviously governmental authority, a bank, none of my people, credit union, and you can read, I'm going to read them all. Now, broker and dealers in securities, I do have one or two there. Investment company, investment advisors, insurance company, state licensed insurance producers, I have some of them. Accounting firms, taxes entities. A lot of these things that you're seeing is because they already have regulation. So they're already reporting just tons of stuff. But 99% of my people are going to be required to do this. Okay. So when, where, and how? Well, my current clients, they have 1 year to file. So sometime in 2024, you're going to have to file a report with FinCEN. Any companies formed after January 1st, 2024 have 30 days to file once they receive public notice from the Secretary of State. You're going to file this form electronically with FinCEN on their website. And of course, with our government, it's not ready. As of today, it's not up and running, but it's supposed to be up and running January 1. What information do you have to give them? Well, they're going to want your company's legal name, including any DBAs, address, jurisdiction of formation, which most of y'all are North Carolina, taxpayer identification number. And not a big deal. You know, you're already giving that on the tax return. But let's see what else they want. Beneficial owner information. They are looking for personally identifiable information for each beneficial owner. Well, what's the definition of a beneficial owner? Any individual who directly or indirectly exercises substantial control over the company and that controls 25%. Once again, most all my clients. What they want from you, they want your legal name, they want your birth date, they want a identifying number, driver's license, state ID, or passport, and then they want a copy of it. They want an image of it. So you're going to be uploading driver's license, so forth. If you decide, well, Craig, I don't have any of those IDs. Well, they got that figured out too. In lieu of acceptable documents, FinCEN is required to offer you a unique identifier called FinCEN ID. They can get you a FinCEN ID for both the company and or the individual. And the problem is it can be used in lieu of the license or the passport. But right now, once again, no application's ready. Now, you know, the government comes out with these laws, but they're never ready. So what if the information changes? You know, what if all of a sudden you don't own 50% and your friend ended up buying part of you out? Well, any changes to the company or beneficial owners, you got 30 days. But you better let them know. They want to know within 30 days of a change. If you found an error, you got 30 days of when you became aware of it or when you should have become aware of it to let them know. Now, the biggest question a lot of people have is, who's going to look at this? Well, the information that's limited by the Corporate Transparency Act The people that can see this information: federal law enforcement, well, that's a bunch of them, national security agencies, obviously state and local law enforcement with a court order, the Treasury Department, I mean, they're fenced in, financial institutions with the reporting consent, government agencies that oversee these financial institutions. FinCEN, on the other hand, is required to implement protocols to secure your information. They're supposed to build and secure and to store the information. Further, they are supposed to establish procedures that only authorized people can access your information. Now, obviously, that can be worrisome to some of us, because nowadays people can hack quite a bit. But what if you say, I don't want to do it? Well, I told you in the very beginning, FinCEN have bite. And if, for instance, you didn't file an FBAR and they caught you and you had $10,000, they were snatching out of foreign bank accounts and they're not giving it back. Well, the penalties right now is $500 per day, civil penalty. That violation continues. At this time, they only have a max. 30 days, 15 grand. And there's also criminal penalties up to 10,000 or 2 years of imprisonment. I mean, obviously, I would strongly suggest that this continues to go through. It is law now. If it goes through, we need to follow up. That's just some humongous penalties. Obviously, there's questions. One of the questions is, who can assist you in this filing? You know, my license falls underneath, basically I can assist people with things that go through Title 26, which is the IRS code. I'm able to help with the FBAR because they basically made an exception for this, for the FBAR, which falls underneath Title 31. Long story short, right now, I don't even know if I can assist you. If I got to get some guidance from the IRS and so forth to see, because I don't want to get smacked with unauthorized practice of law. I have a feeling that they're probably going to let us help, but I've yet to hear the word. The other question, why are they singling out small businesses? I mean, it's anybody over 5 million, don't have to worry about it. So that's just a question that's being posed. And the state has most of this information. Why are they just not reporting it? Why don't FinCEN, why are they putting the ownership on these small businesses to go do it when, quite frankly, North Carolina Secretary of State and the NCDMV has your info? But that's just the questions that remain. I will tell you right now, currently, House Member Patrick McHenry, who represents Mooresville right here, he is House Finance Committee Chair. He has a bill, HR 4035. He is trying to postpone this. I do hope he succeeds. Anybody that's interested in writing a letter, I have one that you can use that's pre-written for you if you would like to send it in. Very invasive. I think it's going to be a burden for some of y'all to have to do. On the other hand, at $500 a day penalty and the bite that they have, we're going to end, if we have to do it, we have to do it. I just don't know what role I'm going to play right now. Those were the 3 things that I wanted to go over with y'all tonight. I'm trying to keep these webinars as short as possible because nobody wants to sit here and listen to me yap for an hour plus. So that's what I have. If you have questions, please email me. I'm hoping that some of you learned something tonight. I really hope that there is some interest out there as far as the SALT workaround. So that's basically all I have. I want you to have a good night. Email me with any questions. And don't forget, our next webinar is September the 12th. Thank you for attending. And this will be posted to my website, hopefully within the week. Thank you. Good night.